India's financial landscape is witnessing a dramatic moment. The Indian rupee has dropped to an all-time low against the US dollar. This unprecedented slide comes amid rising external pressures, notably from new US tariffs on Indian goods and hikes in H-1B visa fees, which have sent ripples across trade, technology, and the broader economy. So, what does this really mean for India and its citizens? Let's break it down. The US, one of India's largest trading partners, recently imposed higher tariffs on specific Indian exports, including steel, textiles, and IT services. Tariffs, in essence, act as a tax on goods entering a country, making Indian products more expensive for American buyers. As demand slows, exporters face reduced orders, impacting India's foreign exchange earnings, and the rupee suffers as a result. Alongside tariffs, the H-1B visa fee hike is another major factor. The U.S. visa policy affects Indian IT professionals and firms that rely heavily on sending talent abroad. Higher fees discourage businesses from hiring overseas, potentially slowing remittances and inflows of U.S. dollars into India's economy. For the IT sector, which contributes significantly to national GDP, this is a double blow. The rupee's decline has broader implications. Imports, from crude oil to electronics, become more expensive in local currency, increasing inflationary pressures. Households feel the pinch as petrol, cooking gas, and imported goods see price hikes. Meanwhile, companies that rely on imported raw materials face rising costs, which could eventually be passed on to consumers. For investors, a weaker rupee presents both challenges and opportunities. On one hand, foreign investors may hesitate to put money in Indian markets due to currency risk. On the other hand, exporters can benefit from a weaker rupee because their goods become cheaper for overseas buyers. This creates a complex scenario where sectors like IT and pharmaceuticals may gain, while import-heavy industries suffer. Let's also examine why the rupee reacts so sensitively. India operates in a highly globalized economy. Foreign capital flows, trade balances, and geopolitical events all influence currency value. Even small shifts in U.S. policies like tariffs or visa changes can have outsized effects on emerging market currencies like the rupee. Historically, India has faced similar pressures. During previous U.S.-India trade tensions, the rupee often saw temporary dips. But what's different now is the combination of tariff increases, visa fee hikes, and global inflationary pressures, making the current slide sharper and more prolonged. The Reserve Bank of India, RBI, is monitoring the situation closely. In response to currency volatility, it may intervene through foreign exchange reserves, adjust interest rates, or use other monetary tools to stabilize the rupee. However, any measures must balance inflation, growth, and liquidity in the domestic economy, a challenging tightrope to walk. What does this mean for ordinary Indians? For consumers, it may result in higher prices for imported goods and services, affecting household budgets. For students and professionals planning to study or work abroad, the cost of tuition and living expenses in foreign countries may rise. Businesses must rethink pricing strategies, hedge currency risks, and adjust supply chains to mitigate losses. Geopolitically, the currency decline signals the impact of global interdependence. India cannot insulate itself from external shocks. U.S. policies, global oil prices, and international market sentiment all have immediate consequences for the rupee and, by extension, the Indian economy. Economists argue that while the rupee's decline is concerning, it also presents opportunities for policy adjustments. Boosting domestic manufacturing, reducing reliance on imports, and promoting exports can strengthen the rupee over time. Programs like Make in India and Atmanirbhar Bharat are designed to reduce vulnerabilities to external shocks. In the short term, India must navigate this turbulent period carefully. The government may need to engage diplomatically with the U.S. to ease tariff tensions, support the IT and export sectors, and provide relief where possible. Monetary and fiscal tools will be key in stabilizing inflation and ensuring that growth momentum is not lost. In conclusion, the rupee's record low value is more than just a number. It's a reflection of the complex interaction between global trade, policy decisions, and domestic economic resilience. While challenges are real, they also offer a chance for India to rethink trade strategies, strengthen domestic industries, and emerge more robust in the global financial system. The coming months will be critical. How India navigates U.S. tariffs, visa policies, and currency volatility will determine not only the rupee's stability, but also the broader trajectory of its economy, investor confidence, and global standing. One thing is clear: in an interconnected world, every policy move abroad can have a direct impact on your wallet at home. India now faces a choice: adapt and strengthen, or risk further exposure to external pressures. The rupee's journey may be volatile, but it is also a wake-up call, highlighting the urgent need for strategic economic planning, robust trade policies, and stronger domestic resilience.